Welcome back to the Deep Dive. We're here to cut through that market noise and really give you the essential analysis behind the numbers.
Yeah, what's really driving things.
Exactly. And today, our focus is squarely in the royalty space. We're looking at Viper Energy ticker VNOM, specifically their Q3 2025 earnings call that happened November 4th, right during market hours.
And that timing, the reaction, it was really something. This quarter, it was probably one of the most strategically packed quarters they've had recently. Huge portfolio moves, really aggressive capital allocation.
But the market hated it.
Well, yeah, the reaction was definitely negative. The stock slipped, 3.0% that day on higher volume, too. So it suggests a real disconnect, between what looked like pretty solid fundamentals and how investors actually felt.
Okay, so that's what we need to unpack today. Why that tension? Why the divergence?
That's the mission.
All right, let's start with the headline numbers then, because this sounds like a classic case, cash beat, but totally overshadowed by some accounting weirdness.
That's exactly it. On the cash side, things looked good. Non-GAAP adjusted EPS, the part attributable to Viper shareholders, came in at $0.40.
Okay, and consensus low.
It's a bit lower,
Okay.
around $0.38 to 39 cents, so a narrow beat there. Production was solid too, averaged 56,087 barrels of oil per day. Pretty resilient.
But there's always a but.
Right, but the market often just grabs the big, scary headline, and that headline was a GAAP net loss. A pretty hefty one, actually. Negative $0.52 per share.
Ouch. And what drove that?
Almost entirely this massive $360 million non-cash impairment charge.
Okay, maybe we should quickly clarify that. A non-cash impairment. What is it exactly, and why does the market, freak out about it sometimes?
Yes, good point. So basically, a non-cash impairment charge is an accounting thing. It's where a company writes down the value of an asset on its books. It says, okay, maybe this isn't worth what we thought.
But no actual cash goes out the door.
Exactly. That's the key for anyone focused on cash flow. It does not affect the actual money the company earned or the cash they have to pay dividends right now. But, it creates this big GAAP net loss figure.
Which looks bad on a Bloomberg terminal.
Precisely.
Yeah.
So headline-driven traders, algorithms, they often just sell, ask questions later. And that seems to be what happened here, despite the pretty solid underlying cash generation.
Which makes the strategy behind all this even more interesting. Let's get into the portfolio surgery they did this quarter. Huge moves. It kicked off with closing that big Sitio Royalties deal, right? All equity, $4 billion. That closed back in August.
Yep, gave them massive scale, instantly. And they didn't waste any time leveraging it. Almost immediately after closing Sitio, they announced they were selling off their non-Permian assets.
Okay.
Signed a deal for $670 million, expected to close early next year, Q1 2026.
So this isn't just random selling. It's strategic. Merger for scale, divestiture for
Purity, focus. It's about doubling down on the Permian Basin. That's where their best rock is, their highest quality inventory. So get bigger, then get focused.
And the cash from that sale. The $670 million, what's the plan there? Net proceeds are going to be, around $610 million after tax?
Yeah, roughly $610 million net. And management was super clear about this. That cash is earmarked specifically to pay down debt faster. They want to hit their long-term net debt target of $1.5 billion.
Okay, let's pause on that debt target. $1.5 billion. You said that's the linchpin.
Absolutely. It's the trigger for the whole shareholder return story. Hitting that number changes everything. They expect, with this divestiture cash, they can pay the revolver down to zero and basically clear the term loan, too.
And they think they can hit that when? Early 2026.
That's the timeline they're pointing to, yeah, thanks to that asset sale money coming in.
And hitting that target, pulling that trigger, it unlocks a different capital return strategy, right? Let's compare what they did this quarter with what they're promising after they had that debt number.
Yeah. Okay. So this quarter, Q3, the return of capital ROC was $140 million. That works out to 85% of their pro forma cash available for distribution, or CAD.
Right. CAD. Let's define that quickly, because that's the key metric here, isn't it? The real measure of cash available to shareholders.
It really is. CAD is basically the actual cash the company generated that's free to be returned to investors after all necessary expenses. Think of it like free cash flow for a royalty company.
Got it. And the dividend this quarter reflected that 85% payout.
Yep. Total dividend was 58 cents per share. That was a base of 33 cents plus a variable kicker of $0.25, which, by the way, was almost a 10% bump from Q2.
Okay, decent dividend. But they also bought back a lot of stock. $90 million for 2.4 million shares. If they're promising almost 100% distribution later, why spend cash on buybacks now? Is that just signaling?
That's a really important distinction they made. Management called the buybacks opportunistic. They explicitly said they see market dislocation. Translation. They think their stock is dirt cheap right now.
Buy it back while it's on sale.
Exactly. They stressed it's a temporary tool. Use it aggressively now, reduce the share count while the stock's undervalued, and while they're working towards that debt target.
Okay. And once they hit the $1.5 billion.
Once they get close to that, likely early 2026, like we said, they have, and I quote, line of sight to return nearly 100% of that CAD to shareholders. And the plan then is primarily through the dividend base plus variable.
So the buybacks are sort of a bridge strategy.
You could see it that way. A bridge to get the share count down before they flip the switch to maximum cash distribution via dividends. Hitting the debt target early, thanks to the sale, just speeds up getting to that 100% CAD payout phase.
Right. The divestiture pulls forward that higher yield profile.
Precisely.
Yeah.
Accelerated the timeline on the big promise.
Okay. That capital return story sounds pretty compelling. But, it only works if the engine underneath is still running well.
Yeah. So let's talk production, guidance. Despite all the choppiness in energy markets lately, VNOM's guidance sounds pretty strong. It really is, surprisingly so. Their Q4 2025 oil guidance is 65,000 to 67,000 barrels per day. That's MBOD. Total is 128,000 barrels of oil equivalent per day.
And the CEO highlighted something about the per share impact.
Yes, this was key. He pointed out that the Q4 oil guide implies something like a 20% increase in oil production per share compared to Q4 of last year.
Wow, 20% per share.
It's that combo effect. You get the increased scale from the Sitio merger, plus the denominator shrinking because of those aggressive share buybacks.
Okay, that makes sense. And looking further out into 2026.
The outlook there is for mid-single-digit organic oil production growth, just from the assets themselves.
Mid-single digits organic, which for a royalty company is actually pretty decent.
It is. But again, layer on the ongoing share count reduction from those buybacks. And that mid-single-digit organic growth translates into double-digit year-over-year oil production growth per share in 2026.
Double digits per share.
Yeah.
That's a powerful message for investors.
It's a huge value proposition, especially for a royalty model that usually finds it tough to grow organically.
So how are they sustaining this? What's the competitive edge here? How does this combined Viper-Sitio asset base keep capturing so much third-party activity?
Well, it's the footprint, really. The combined acreage gives them incredibly broad, but also efficient exposure across the Permian. They're touching wells drilled by almost every serious operator out there.
So they benefit from everyone else's drilling.
Pretty much. They said they've consistently captured almost half of all the drilling activity in the Permian that wasn't done by their parent Diamondback over the last couple of years. That gives them durable growth exposure.
Interesting. And management mentioned something about synergies too, tech stuff.
Yeah, they specifically called out bringing over some of Sitio's capabilities in big data, automation, machine learning.
Okay, buzzwords. How does automation actually help a company that just collects royalty checks?
It sounds like jargon, I know, but think about it. They have interest in something like 35,000 wells now.
Wow, okay.
Keeping track of production from all those wells, making sure the royalty payments are right, identifying new wells coming online. It's a massive data challenge. These tools help them do that faster, more accurately, and more efficiently.
So it's about making sure they get paid correctly and on time.
Exactly. It's about maximizing their net royalty interest collection efficiency, squeezing every penny out faster. And they even hinted it could eventually help automate things back at the parent company, too.
Okay, so let's try and tie this all back together. We started with this disconnect. We've got a clear cash beat, aggressive capital returns, 85% now, with a clear path to nearly 100% very soon, and double-digit per-share growth guidance. So why on earth did the market react negatively?
Well, putting aside the general macro headwinds for energy stocks lately.
Yeah, energy has lagged. Crude softened a bit in Q4.
Right. VN itself was down about 2% over the month leading into this, while the XLE was flat, so there was weakness already. But the specific VNOM reaction seems to boil down to two main things. First, that gap loss fixation we talked about. The market just couldn't look past the headline impairment number.
Even though it was non-cash.
Even though it was non-cash. And second, this issue of what management called unnatural holders.
Ah, yes, the post-merger sellers. Let's clarify who they are again.
So when the Sitio merger closed, former Sitio shareholders got VNOM stock. Now, some of those individuals or funds, maybe they didn't want exposure to a royalty company, maybe they had specific investment mandates, Whatever the reason, they aren't natural long-term holders of VNOM.
And they represent a decent chunk of shares.
About 13% of the outstanding shares, according to management. So if they decide to sell simply because they don't want to hold VNOM, not because of fundamentals, that creates this technical selling pressure, an overhang, that weighs on the price.
And management addressed this head-on, this market consternation.
They did. They were pretty direct. They basically said, look, we know about this potential overhang, and we have the financial firepower, meaning cash and borrowing capacity, to absorb that selling if needed. They're signaling they'll support the stock against technically driven weakness.
Interesting. And they also mentioned the parent company, Diamondback.
Yeah, that was another key point. When asked if Diamondback might step in and buy more VNOM shares itself, management said that is, quote, certainly on the table.
Okay, so they're signaling multiple layers of support. Internal buybacks plus potential parent company buying.
Exactly. It suggests they're using the entire corporate structure, the whole complex, to tackle what they clearly see as a significant undervaluation in VNOM's stock price.
All right. It is time now for that segment where we pitch a slightly outrageous, but maybe plausible, trade idea based purely on this earnings call material. And remember, everyone, this is just analysis and discussion, definitely not financial advice.
Okay, let's do it. The trade we're calling this one is the gate noise defiance trade.
Gate noise defiance. I like it. What's the core thesis?
The thesis is pretty straightforward. VNOM looks structurally cheap right now, mainly because of those two temporary issues we discussed. One, the market's overreaction to the non-cash gap noise. Two, the technical selling pressure from those post-merger unnatural holders.
And these temporary factors are masking.
They're masking what looks like accelerating free cash flow per share growth. You've got that mid-single-digit organic growth from the assets, plus management is aggressively shrinking the share count through buybacks. That's a powerful combo the market isn't pricing in yet.
Okay, so how do you structure a trade to play that?
You go long VNOM stock, basically betting alongside management that it's cheap. But to add a little structure, maybe think about it as a calendar spread, kind of betting that the current uncertainty and volatility will resolve.
So specifically,
you could buy the stock itself, maybe pair it with buying some slightly longer dated call options, say out in Q1 2026. And then to maybe help finance it or add protection, you could simultaneously sell some near-term protective put options, maybe with a Q4 2025 expiry. You're betting the near-term noise fades and the longer-term value emerges.
Gotcha. And what's the key catalyst that makes this trade work? The trigger?
The big one is the closing of that $670 million non-Permian asset sale. That's expected in Q1 2026. When that closes, the cash comes in, the debt paydown accelerates, and it formally triggers that shift towards the nearly 100% CAD return framework.
So it removes the last big piece of strategic uncertainty.
Exactly. It should force the market to stop focusing on the noise and look squarely at that double-digit per share growth rate and the incoming flood of cash distributions. That's the inflection point.
Okay, let's quickly wrap up the key takeaways from this deep dive then. Viper Energy, VNOM. They delivered a clear cash beat despite the gap noise. They're guiding for really strong double-digit per share oil production growth next year. And the strategy is crystal clear. Focus on the Permian, pay down debt rapidly, buy back stock while it's cheap, and get ready to return almost all cash flow to shareholders very soon.
Yeah, that's the story. Which leaves us with a final thought for you, the listener. Given how clear management was about the capital allocation plan, that line of sight to 100% CAD return, the focus on Permian purity, does the market's negative reaction really signal some deep skepticism about whether that mid-single-digit organic growth is actually durable? Or is it truly just an overreaction to the temporary stuff, the impairment charge, the seller overhang?
And maybe one more twist.
Go on.
If management really believes the stock is this cheap, and they keep hinting Diamondback could step in, should you maybe be watching for a bigger corporate move? Like, could Diamondback just decide to take VNOM private altogether and cut out the public market noise completely?
That's definitely provocative food for thought. A lot to unpack there.
Indeed. Well, thank you for joining us for this deep dive into the VNO earnings call. We will talk to you next time.